In this lecture, we will cover the CFA Level 2 reading on multinational operations. This is a long and important reading, and here are the sections that we will cover. The two major aspects that we address in this reading are foreign currency transactions and the translation of foreign currency financial statements. Section 2 deals with foreign currency transactions. Let's first look at a few basic definitions. Presentation currency. This is the currency in which financial statement amounts are presented. It is generally the company's residence or where the company is domiciled. The functional currency. This is the currency of the primary economic environment in which an entity operates. We will talk about the functional currency in more detail later. In the context of foreign currency transactions, generally these two currencies will be the same. You will hear the term foreign currency and the term foreign currency transaction. A foreign currency transaction is a transaction in any currency other than the functional currency of a company. There are two broad types of financial currency transactions, either import-export transactions or lending-borrowing transactions. These can result in foreign currency assets and liabilities. As a simple example, let's say that you have a United States-based company which imports from Mexico. So goods are imported, but the payment is made in Mexican peso at a later point in time. This means that an accounts payable is created payable in the foreign currency, and that will result in some foreign currency risk. An export transaction will also result in some foreign currency risk if there is a difference between when the sale happens and when the money will be received. And again, the foreign currency risk is there if the money is being received in the foreign currency. We'll now talk about these transactions in a little more detail. Let's look at an import transaction first. We have foreign exchange risk or foreign exchange exposure if the importer is required to pay in the foreign currency and the settlement date falls after the purchase date. The risk to the importer is that the functional currency may weaken against the foreign currency. So going back to my example, if we have a United States based company, then we are assuming that the presentation currency and the functional currency is the dollar. This particular company imports goods from Mexico and needs to make a payment in Mexican peso at a later point in time. The risk here is that the Mexican peso appreciates, which is the same as saying that the US dollar, the functional currency in this case, weakens. With an export sale, there is foreign exchange risk if these two conditions hold. The exporter agrees to be paid in the foreign currency and settlement date falls sometime after the sale date. Again, let's go back to the US company with dollar as the functional currency. Let's say that this company exports goods to the UK, which means that the payment will be made in pounds. If this payment is being made at a later point in time and the pound weakens, which is the same thing as saying the dollar strengthens. So if that happens, then this will have a negative impact on the exporting company. That is the foreign exchange risk. Both US GAAP and IFRS require the change in the value of foreign currency assets or liabilities resulting from foreign currency transactions to be treated as a gain or loss reported on the income statement. So whether this gain or loss is realized or unrealized, it needs to be shown on the income statement. Let's look at example 1 from the curriculum, which deals with settlement before the balance sheet date. I want you to read this and try it on your own before looking at the solution. Here is roughly what you should come up with, and I'll just highlight a few points. Notice that our company, Finco, is based in Europe and the functional currency is the euro. The foreign currency in this context is the Mexican peso. And this is an import related transaction. So goods are being imported and a payment needs to be made in Mexican peso at a later point in time. The next point to note is that in the way the currency exchange rates are given, the Mexican peso or the foreign currency is the base currency because we have one unit of the base currency. And also the Mexican peso is appreciating, which means that the euro is weakening. This obviously is a negative for the importing company because it is now having to pay in peso, which is more expensive. This is a higher number, and that is shown over here through the fact that there is a foreign exchange loss because of the appreciation of the foreign currency, and that carries over to retained earnings. This is a realized loss. The balance sheet date is 31st December. The loss is realized on 15th December when the payment is made. So we see the loss in the income statement over here, and we also see the impact in shareholder equity. Example 2 deals with a situation where settlement happens after the balance sheet date, and I want you to try this first before looking at the solution. Here is what you should get. Now note that this is an export transaction. So goods are being exported and money is being received later. The functional currency is the euro. The foreign currency now is the pound. And notice that between 15th December and 31st December, the pound appreciated. And this is good news now because we are dealing with an export transaction. So pounds are coming in. Since pounds are coming in, we are happy if the pound goes up in value. If you look at 15th November and then 31st December, because of the appreciation of the pound, there is a foreign currency gain. That gain is equal to 200. But then between 31st December and 14th January, the value of the pound goes down. And that is reflected here as a negative number. The 200 is shown as an unrealized gain on the income statement, but on 15th December, the overall gain of 150 is realized. Between 31st December and 15th Jan, there is a loss of 50. Note that just because we have an unrealized gain of plus 200 over here, this is not necessarily indicative of the final realized gain for the company. This slide summarizes what we are talking about and is important from a testability perspective. Whether a change in exchange rate results in a foreign currency gain or loss depends on two things. The nature of the exposure to foreign exchange risk, whether it's an asset such as a receivable or a liability such as a payable, and the direction of change in value of the foreign currency. Is the foreign currency strengthening or weakening? For an export sale, an asset is created. The foreign currency strengthening will be a good thing. The foreign currency weakening will result in a loss. With an import purchase, the situation is the other way around. And again, make sure you know this table very well. A few basic analytical issues. Both IFRS and US GAAP require foreign currency gains and losses to be reported in net income even if they have not yet been realized. But neither standard indicates where on the income statement these should be placed. These are the two common treatments. Number one, as a component of other operating income or expense, and number two, as a component of non-operating income/expense. In some cases, this is shown as part of financing cost. With this point, notice that given the subjectivity, there is work for an analyst to do when comparing two different companies. If one company is reporting the transaction gains and losses in the operating part of the income statement and another is reporting numbers in the non-operating part, then clearly adjustments have to be made before a comparison. Example 3 in the curriculum illustrates how the calculation of profit margins, especially operating profit margins, are impacted by foreign currency gains and losses. This is a very simple example, so I'm not covering it here, but I would like you to read this from the curriculum. Also, as we saw in example 2, unrealized foreign currency gains and losses on the balance sheet date are not reflective of the ultimate realized foreign exchange gains and losses. Section 2.3, disclosures related to foreign currency transaction gains and losses. Both IFRS and US GAAP require that foreign currency gains and losses for a given period be shown on the income statement. They have slightly different ways of stating this, but effectively both statements here mean the same thing. A company might disclose that the transaction gains and losses are immaterial for a given period. This might happen if the gains and losses cancel each other out. There might also be a situation where in a given period the foreign currency transactions are extremely few. Some companies might use hedging instruments to minimize foreign exchange risk. If this does happen, then the company needs to disclose what hedging instruments are being used. We now come to section 3, translation of foreign currency financial statements. This section represents 80% of the reading and is extremely important. There are several subsections in this reading. Before we go into the details, let's go over some basic conceptual issues related to translation. And we'll understand this through an example given in the curriculum. We have a Spanish company called Spanco, and when I say we, I will often refer to us as this company. Our context will be that we are the parent company and we have subsidiaries in other countries. So for example, in this case, we are Spanco. This is the parent company based in Spain. So the presentation currency or the currency in which we report our numbers is the euro. We have a subsidiary in America and the name of that company is Americo. Obviously, Americo will buy and sell over here in America. The US dollar is the foreign currency. On balance sheet dates, the assets and liabilities of this subsidiary need to be translated to euro, and these translated assets, liabilities need to be shown as part of the consolidated financial statements of Spanco. When we do this translation, and note that we are now using the term translation as opposed to the earlier section where we were talking about transactions. So when we translate financial statement elements, there are two core questions or conceptual questions that need to be addressed. The first is, what is the appropriate exchange rate to be used in translating each financial statement item? For example, should we use the exchange rates that were in effect when the asset was purchased? Do we use the average exchange rate, the exchange rate at the end of the period, in other words, the balance sheet date? So there are several exchange rates that could be used, and we need to figure out which one to use. The second question is, how should the translation adjustment that inherently arises from the translation process be reflected in the consolidated financial statements? In other words, how is the balance sheet brought back into balance? So let's dive into these conceptual issues by looking at some numbers. Again, we continue with Spanco. Amerco is the American subsidiary which is established on this date, the end of, let's say, 2001. And here is the investment. The investment is 10,000 euro. Conveniently, our exchange rate when this subsidiary is established is $1 is equal to 1 euro. This is what the American subsidiary then does. So when the American subsidiary starts, the balance sheet in US dollar terms looks like this. It is a very simple balance sheet. And the translation process is also straightforward because we have 1 euro to $1. So in the translated euro terms, the balance sheet looks exactly the same. But then the dollar weakens relative to the euro. On 31st March, so that's 3 months later, 0.8 euro is equal to $1. Note that we are taking the foreign currency, which is the dollar, as the base currency, 1 unit of the dollar. Now, given this new rate, how will we translate the balance sheet of the subsidiary? Broadly speaking, there are two translation methods. One method is that all assets and liabilities are translated at the current exchange rate. When we say current in this context, we mean the current rate on 31st March 02, which is 0.8 euro to the dollar. The other method is that only monetary assets and liabilities are translated at the current rate, and non-monetary assets and liabilities are translated at historical exchange rates. Historical exchange rates would be the rates that are in effect when, let's say, the assets were purchased. This is what the balance sheets would look like, or the translated balance sheets would look like under the two different methods. Method one was that all assets and liabilities are translated at the current rate. So notice that this 0.8 is the current rate. The C stands for current. So all assets and liabilities are translated at the current rate. Common stock is translated at the historical rate. Just remember that this happens no matter what method we use, and we'll discuss this in more detail later. Method 2 says that only monetary assets and liabilities are translated at the current rate. So cash obviously is monetary, so that's translated at the current rate. Inventory is non-monetary, so this is translated at the historical rate per method 2. And then liability is monetary, so that's translated at the current rate. Common stock again is translated at the historical rate regardless of the method. Method 1 is called the current rate method. So all assets and liabilities translated at the current rate. Method 2 is called the monetary non-monetary method, or the temporal method. And the term used in the curriculum, in the learning objectives, and then later in the practice problems is temporal method. So effectively, the two translation methods are the current rate method and the temporal method. The reasoning behind the temporal method is that all assets and liabilities measured at current value on the balance sheet should also be translated at the current exchange rate. If an item is carried at historical cost, then it should be translated at historical rates. So that makes sense. On the other hand, if an item is carried at current market value or current fair value, then it should be translated at current rates. Section 3.2, Translation Methods. This, I'd say, is one of the most important slides in this presentation, and if you do get a question related to translation, it is very likely that you will be tested on the concept that we discuss here. And the concept is this: how do we decide which method to use? How do we decide between the current rate method and the temporal method? And the answer is shown right here. If the foreign subsidiary's functional currency is different from the parent's presentation currency, then we use the current rate method. On the other hand, if the foreign currency's functional currency is the same as the parent's presentation currency, then we use the temporal method. Now, clearly we need to understand what exactly is the functional currency and how do we decide on the functional currency of the subsidiary. And these are the factors that you consider. What is the currency that influences sales prices? And remember, we are talking about the subsidiary here. So if we are the parent company, we are Spanco, and our presentation currency is the euro. Our subsidiary is in America. The foreign currency or the local currency in America is obviously the dollar, but what is the functional currency? This might not obviously be the dollar. If there is a business, if a subsidiary in America buys in dollars, sells in dollars, the entire economic environment is dollar based, the pricing is based on the competitive environment in the United States, then it makes sense for the functional currency to be the dollar. So if you look at all these bullet points, this will help you decide whether the dollar is the functional currency or not. You might have another situation where effectively Spanco is exporting product to the United States, and the product is being sold at a price which is determined based on the dynamics in the euro market. And let's say that the salaries are also based on European salaries. Then we could say that even though goods are being sold in America through this subsidiary, but the functional currency is the euro. The case that I just talked about, where even though the subsidiary is in America, but the functional currency is the euro, then we have this scenario, and we need to then use the temporal method to translate the financial statement items from the subsidiary to the consolidated balance sheet of the parent. On the other hand, if we have this situation where the foreign sub's functional currency is different, then we would have to use the current rate method. This is critical, but students often forget. So I'll give you two little techniques to remember. One simple thing to remember is just DC, or let's say direct current. If there is a difference between the foreign sub's functional currency and the presentation currency, then use the current rate method. That's one silly way of remembering. The other somewhat intuitive method is the following. If the foreign subsidiary is using a different currency altogether relative to the parent's presentation currency, that is more risky relative to this other scenario where the functional currency is the same. When there is more risk, then we tend to be more careful or more conservative. The more conservative thing to do is translate all assets and liabilities at the current rate. So again, that's what's happening over here. Now we'll talk about the current rate method in more detail, and the next slide will talk about the temporal method in more detail. So we emphasize this point again. If the foreign entity's functional currency is different from the parent's presentation currency, then use the current rate method. What is the procedure here? All assets and liabilities are translated at the current exchange rate at the balance sheet date. So if the balance sheet date is 31st December 2002, then we look at the exchange rate on that day and translate all assets and liabilities based on that rate. Stockholders' equity accounts are translated at historical exchange rates. Just take this as a given. And finally, revenues and expenses are translated at the exchange rate that existed when the transactions took place. This can be a little cumbersome. So for practical reasons, what most companies do is take the average exchange rate over the period and use that average exchange rate to translate all revenue items and expense items. With the current rate method, there is going to be a net translation gain or loss, and this happens because the exchange rate changes. This net translation gain or loss does not flow through the income statement. It needs to be reflected in equity. In other words, there is a component in equity that covers the net translation gain or loss. You might be wondering why the translation gain or loss goes straight to equity and bypasses the income statement. The reason is that you are the parent and you have invested in this foreign subsidiary. The foreign subsidiary is operating in its own currency. Remember here, the functional currency is different from the presentation currency of the parent. So if the foreign currency appreciates and there is a gain, you are only going to realize that gain when you spin off or sell this subsidiary, which is not likely to happen anytime in the near future. Remember the going concern assumption here. So if this is not going to happen in the near future, then it does not make sense to have the translation gain be reflected in the income statement. Very roughly speaking, this is analogous to the way we treated available for sale securities earlier on in the course. Remember, with AFS, even though AFS securities are shown at fair value or market value, but the unrealized gains or losses do not flow through the income statement. Unrealized gains and losses go straight to equity. Same treatment over here. The next point has to do with the balance sheet exposure. When we talk about balance sheet exposure, what we are talking about is the fact that assets are being translated, liabilities are being translated. So net, are we going to have assets being translated or liabilities? If the value of assets being translated is greater than the value of liabilities being translated, as shown over here, then we have a net asset balance sheet exposure. So effectively we then have a net asset, which means that with a net asset, if the foreign currency appreciates, then that will have a positive impact on the balance sheet. With the current rate method, since we are translating all the assets and all the liabilities, generally there will be a net asset exposure. Next we come to the temporal method, which is a little more complicated. We use this method when the foreign currency's functional currency is the same as the parent's presentation currency. With assets and liabilities, here is the procedure that we use. Monetary assets and liabilities are translated at the current exchange rate. So remember, monetary at the current exchange rate. Non-monetary assets and liabilities measured at historical cost are translated at historical exchange rates. Non-monetary assets and liabilities measured at current value are translated at the exchange rate at the date when the current value was determined. Stockholders' equity accounts are translated at historical exchange rates. So again, remember the fact that with both methods, the stockholders' equity is translated at historical exchange rates. And then revenue and expenses. Revenue and expenses other than those expenses related to non-monetary assets are translated at the exchange rate that existed when the transactions took place. Expenses related to non-monetary assets such as cost of goods sold, depreciation and amortization are translated at exchange rates used to translate the related items. We will understand these points through examples. First, let's look at a few finer details related to the temporal method. When using the temporal method, companies must keep record of the exchange rates that existed when non-monetary assets such as inventory are acquired, because we need to use that particular exchange rate for inventory which was in effect when the inventory was acquired. Remember, inventory is considered a non-monetary asset. The historical exchange rates used to translate inventory and then cost of goods sold under the temporal method will differ depending on the cost flow assumption. Recall from before that cost flow assumption could be last in, first out, and weighted average. And we are going to look at an example later that deals with these possible scenarios. The translation adjustment needed to keep the translated balance sheet in balance is reported as a gain or loss in net income. So remember, this gain or loss, the translation gain or loss with the temporal method does flow through the income statement, and this is different from the current rate method where the translation adjustment or translation gain loss is shown through equity. Now, why the difference? I've already explained the reasoning behind the current rate method. With the temporal method, we are saying that the functional currency of the subsidiary is the same as the functional currency of the parent, or more precisely, the functional currency of the subsidiary is the same as the presentation currency of the parent. If this is the case, then whatever activity is happening related to a foreign subsidiary, even though sales might be happening in the local currency, but the local currency will be converted relatively quickly into the functional currency, which is the same as the presentation currency. Since this conversion is likely to happen in the near future, it makes sense to show translation gains and losses in the income statement. Very roughly speaking, this would be analogous to held for trading securities. Next, we come to balance sheet exposure. Here again, we look at exposed assets versus exposed liabilities. And I want to make sure you understand what this term exposed means. By exposed, we mean the assets that will be translated at current rates, and exposed liabilities are the liabilities which will be translated at current rates. Assets and maybe some liabilities which are being translated at historical rates are not exposed to variations in the foreign exchange rate. Generally, with the temporal method, we are likely to have a net liability exposure because most probably the monetary assets, which are the only exposed assets, are probably going to be less than the monetary liabilities. And in the example that we will consider over the next few slides, this is the scenario. Here I'm simply reproducing Exhibit 4 from the curriculum, which summarizes what we've been talking about. So I want you to carefully go through this and make sure you understand what is being stated. On the left, we have the current rate method, and on the right, we have the temporal method. Note that with the temporal method, non-monetary assets are being translated at historical rates. Note that with revenue and expenses, both methods use the average rate. However, under expenses, if we have non-monetary assets, then such as inventory, and then when inventory is sold, then the relevant expense is the cost of goods sold, then we use the historical rate. Now I'll have you do this question, and I'm going to discuss it with you because over the years many students have had issues with this combination of FIFO, LIFO and the translation method. So try this first and then I'll explain what you need to do. Here is the solution. Given rising prices, FIFO COGS will be the lowest, and given a depreciating currency, the current rate method will give us the lowest COGS. So that's the answer, FIFO and the current rate method. Now, what is the logic that has been used? Let's break this into two parts. One is the impact of the cost flow assumption, and the second is the impact of the translation method. And I'll go back to my very simple scenario. 1122. We have rising prices, and note that this is a US company with a sub in Turkey. The relevant numbers are the costs in Turkey, the costs related to the subsidiary, and the value of the foreign currency. The inflation rate or the prices in the parent country don't matter in this scenario. When you have rising prices, then which method will give you the lowest COGS? Which inventory flow method? And the answer is FIFO, because with FIFO we have first in, first out. So the low cost items that came in first are being sold. So FIFO is going to give us the lowest COGS. That is fairly straightforward. What about the current rate method versus the temporal method? Remember, with the current rate method, we are using the average exchange rate, whereas with the temporal method, we are using the exchange rate in effect when the items were bought and sold. So let us say that we have an exchange rate of 1 and we are taking the Turkish lira as the base currency. We don't know the exact exchange rates, and that's not really relevant. What we do know is that the Turkish lira is weakening. So we can say that the exchange rate goes from 1 down to 0.5. That's substantial weakening, but it will help illustrate the point. We can then say that on average the exchange rate was 0.75 over the year. This is the rate that will be used by the current rate method. What about the temporal method? The temporal method is saying that we use the rate that was in effect when these items were sold. The items were sold early in the year, and when they were sold, the cost that we are using is the cost based on early in the year. So that means that we will also need to use the exchange rate based on early in the year, which is relatively high. Remember, the currency is depreciating. So if we are using these relatively high exchange rates, then COGS as expressed in the presentation currency is going to be relatively high with the temporal method. Therefore, we can say that the current rate method is going to give us a lower COGS when expressed in the US dollar or the parent's presentation currency. Make sure you understand this, because when you look at the practice problems at the end of this reading, there will be a few questions that deal with the same concept. And I know that in the past, many students have been confused by this particular scenario. Next, we come to example 4, and this is a little bit tricky because the discussion on inflationary economies actually comes later in the curriculum. But here what has been done is An example has been given again with a US based parent company and a subsidiary in Turkey, and we are told that in Turkey we have very high inflation, and then we are asked to translate using the current rate method, and then translate using the temporal method, and then translate using a third method. So given what you've learned so far about the current rate method and the temporal method, I want you to do the translation and see if you come up with the same numbers shown over here. We will make a separate video available that goes through these numbers in detail. Don't worry too much about this method right now. When you go over a later segment dealing with hyperinflationary and highly inflationary environments, then this particular method will make sense.